Well, it's been rare to see bank consolidation in this country, but very quickly we've been talking about two deals. First, it was Royal Bank acquiring HSBC's Canadian assets, and then recently National Bank, which some wondered if they might take a run at Laurentian, ended up putting together a deal to acquire Canadian Western Bank. Now, National has had a hot hand in the eyes of investors, although when the deal was announced, National shares sold off. That caught the attention of Barry Schwartz of Baskin Wealth Management. He's back with us now to talk a little bit more about the opportunity you saw in that. Walk us through your thinking.
Well, we've been National Bank shareholders for 20 plus years. And luckily, it's been the best performing Canadian bank going back since 2000. And it's not by accident. The company the table has been set by Louis Vachon, who was one of the longest standing bank CEOs. He retired a few years ago, but really conservative, focusing on Quebec, growing slowly into Canada, ignoring the U.S. like the other Canadian banks didn't do, which, the U.S. has turned out to be a disaster to invest in there for Canadian banks. Anyways, getting back to National Bank, the stock has fallen about $10 since it offered to acquire Canadian Western Bank. So essentially, the market is saying that this acquisition would be value destructive. That makes no sense to us because National Bank, their team is one of the best operators of banks that we've ever seen, right up there with JP Morgan. They know how to integrate acquisitions. They stole the business from TD Waterhouse many years ago. That turned out to be a huge value add for the company. We think this is a perfect acquisition for National Bank. Everybody says, I don't want to invest in National Bank. It's too Quebec-based, too regional. This solves one of their problems. It also gets them a lot of assets in a faster-growing economy, and probably doing it, John, right when we're cutting interest rates, which should alleviate fears of future credit losses.
Let's stay on some other stock ideas. A connection to Quebec, Alimentation Couche-Tard, a company that never shies away from doing deals itself. Actually, that's been the name of the game with that convenience store operator going global looking for acquisitions. This is another name on your watch list. How come?
Yeah, its stock has kind of done nothing in the last few months, and probably for good reason. Fuel margins have come off a bit. A lot of worries about the lower end consumer in the U.S., maybe not spending as much money on beer and cigarettes or what have you. So that's really given us an opportunity to acquire the stock that we think is a very inexpensive valuation. The one thing I was negative on Canada a few minutes ago, but one thing that I do like about some of the Canadian opportunities is you can find a lot of great businesses trading at cheaper valuations than their U.S. counterparts. Couche-Tard's trading around 17, 18 times earnings. Similar companies in the U.S. trade at well past 20 times earnings. One of the best operators, one of the best acquirers in the world of assets. And we think they'll get over this hump in the next 6 months. And here's your chance to buy a good stock at a reasonable price.
I'm glad you brought up the value opportunity because we talk endlessly about our energy sector, and those who are deeply invested in it, they'll share the math with you, and it is very compelling. But when you, at the end of the day, I mean, you watch the sector, if you had to pick a name or a couple of names in a sector where arguably a lot of stocks would offer value if the market wants to unlock it, where would you look?
Well, I always like to stay with the safest companies run by the best management teams that have great balance sheets. And for us in energy, it's CNQ and Tourmaline Oil. And a lot of investors now always want dividends. They want that dividend income, but they've been concerned about the telcos, the pipelines, the utilities, worries about the growth, what's coming from them. Tourmaline and CNQ, high dividend yields. Most these companies are raising their dividends left and right, paying special dividends. Their balance sheets are in good shape. And as long as energy prices don't fall off a cliff, CNQ has raised its dividend 20 plus years in a row. And that's with oil and gas going up and down like a toilet seat. So we feel these are the right places to be for safety and dividend growth. And if oil prices and nat gas prices rise from here, you're going to get some icing on the cake.
All right, well, CNQ happens to be a top 10 influential stock within the TSX itself, which you mentioned. We don't have a big tech exposure, but we got banks in there, we got Shopify and CNQ, and the rails, including CN Rail. CN Rail is another one you've been watching.
Well, there's been a little worries right now. There's going to be a strike, and that's kind of hurt the rails, as well as the U.S., I think. We've seen some economic numbers where people are worried about a slowdown, so the transports always get hurt first. Bottom line, though, CN Rail valuation quite inexpensive. CN and CP have been double-digit growers for decades plus, high free cash flows, high returns on invested capital, and they're really guiding for strong results going forward. Both CN and CP are guiding for double-digit earnings growth out to 2026. I'm not sure the market is paying attention here.
All right. Well.